There are so many different things that you can invest in nowadays, right? Tech stocks, companies that offer a dividend, index funds, cryptocurrencies, NFTs, all of this. It can feel really overwhelming, especially if you're new to investing. And in this video, I'm going to break down three main categories of investing, specifically when it comes to the stock market. I'll be comparing growth stocks, index funds like ETFs, and dividend stocks. But before diving into those, it's important to know what your risk profile is as an investor. And if you don't know what a risk profile is, let me explain with this story. The Philly Special. The what? The Philly Special. It's one of the best trick plays in Super Bowl history. That's right. I'm a bit of a football junkie. And it was the Eagles versus the Patriots. 4th down and goal. And the head coach of the Eagles, Doug Peterson, known for having a high tolerance for risk, goes for it on 4th down. It was the highest stake game of his career. And rather than running a normal play, he snapped the ball directly to his running back, who tossed it to his tight end, that throws it into the end zone to who else? But there used to be backup, currently on fire quarterback Nick Foles. If you don't know, you never throw to a quarterback, especially a backup. And this coach risked it all, but his high risk, high reward paid off, putting them ahead of the Patriots, and they would go on to winning the game, becoming Super Bowl 52 champions. Now, Coach Doug Peterson, he knew what his risk profile was. It dictated how he approached the game of football. We need to know what our risk profile is and what type of stocks align with how we want to invest. Do you want to go for it on 4th down, or you'll take the more conservative approach? There are three main categories of stocks that each have different risk profiles. We have growth stocks, index funds. These can be thought of like mutual funds or ETFs. And 3, we have dividend stocks. A growth stock is a share in a company that is anticipated to grow at a rate significantly above the average growth of the market. These are type of companies that usually reinvest money they make back into their company to accelerate growth in the short term. Think of the meteoric rise of a lot of tech companies, the ones that we go, to the moon, companies that raise a lot of money and inject it back into their business to fuel rapid growth. Investors can earn money through the dramatic rise of the stock price itself. So you're hoping to buy a company and have it 3x, 5x, heck, 10x the price you bought in at. So a $10 stock becoming $50, and then you sell. If you're investing in growth stocks, you typically need to be able to stomach potential large falls in the stock price as well, because this is high risk, high reward, right? Because where a company is betting a ton of money on themselves to grow quickly, it can only take a couple bad missteps for the company to fail, right? Can anyone in the back say MySpace any louder? An index fund is a mutual fund or ETF designed to track specific bundles of stocks. For example, the S&P 500 index fund averages out the value of 500 of America's largest companies. They take Amazon, Disney, Visa, Coca-Cola, and say, on average, these stocks are up 3% for the day. If that was to happen to your whole index fund, it would be up 3%. These are safe investments where you're shooting for steady growth with limited downside, because think about it. If you have a ton of companies bundled together, companies that go down aren't felt as much because it has other companies that go up that are balancing it out. You're hoping that over time, the companies that go up outweigh the companies that go down, and you get that steady growth upwards over a long period of time. This type of investment embodies the whole set it and forget it philosophy, and that's why most retirement accounts focus on these type of funds. A dividend stock is a share in a company that pays out regular dividends, which is just a confusing, jargony Wall Street way to say a sum of money that's paid out to investors from a company's profits or reserves. So they take a portion of how much money they make and disperse it to their investors depending on how much stock you actually have in the company. They're paid out monthly, quarterly, or yearly, depending on the specific company. But a perfect example of someone who benefits from dividend stocks is my grandma. I call her Yaya. And because she's been investing for a long time, right? A lot of years, she has developed large positions in companies like Delta or Coca-Cola that have these large dividends. If those companies have a good year, she could be making dividend payouts in the tens of thousands, right? And there are usually large companies that don't have crazy growth in terms of their stock price because they already are so well established that you're not getting that crazy growth. But if you acquire a large position in the company over time, you get a large payout that a lot of people who might be retired actually can live off of. Now, when deciding what type of stocks to invest in, you need to determine your risk profile. Would you rather play it safe and look for slow growth, or are you willing to invest in more volatile stocks that could produce higher returns while risking a lot more downside? A good rule of thumb is to ask yourself, if a stock you recently purchased suddenly dropped 15%, how would you handle that? Could you stomach it? The answer to that question could give you a solid indicator what you can actually do as an investor. Today, we learned that 1, growth stocks are more risky with high price growth. And 2, index funds are more steady with a medium price upside. And lastly, 3, dividend stocks equal much safer investments with steady cash payouts, but limited price growth potential. Subscribe to my channel, and if you're on Twitter, you can actually follow me as well at John Tunger, where I'm constantly giving my thoughts on investments and where the market's at.